we are live. Another very volatile. I guess it's actually not. Well, this week was more volatile. This week actually moved
Yeah,
around a bit.
yeah, yeah,
What a lot of times people think straight line moves are volatile, and they're actually not.
yeah. No, if you like volatility, this market certainly is not disappointing. I mean, it just even though we keep having these limit up type moves, you are getting some trading where until proven otherwise, the path of least resistance is still higher, and it's becoming, I think, more volatile even in cash and trying to figure out where actual cash is. Fraser comes on at the low end of the market. You've got other mills, so you probably in the West alone have $100, $110, $150 swing on what you're hearing in pricing on 4-inch and 6-inch. So it just it's becoming a very fragmented market. Are you purely a Western SPF guy, Eastern SPF guy? Can you buy trucks? Can you go pick up the trucks? Can you stay in Canada? Are you a car only into the US? Are you wholesale? Are you distribution? Are you end user? And you're hearing numbers in that $150 range. And the other thing that I think is huge, just it doesn't seem to be a lot of volume. It's let's sell a truck, let's sell a car, kind of reassess, go off the market, maybe come back 2-3 hours later, sell another truck, sell another car, and just rinse and repeat day after day. With, I just question in the last $200 of this move, how much volume has actually been transacted at the sawmill level?
That's an interesting perspective or an interesting question because I think it's probably pretty light. I mean, as we know, when the mills extend their order file, they sell less of it. So I'm not going to sell 95% of what I'm scheduled to produce because I don't want to get caught having sold something that I can't make if I have an issue, right?
Yeah, yeah. And I think from a rail car allocation, I think there's slight improvement, but I would have to wager that most BC sawmills are anywhere from 30% to 60% rail car allocation. So I think that's the big driving force here, is that we're only going to sell based upon that rail car allocation. So, at the end of the day, there's a lot of wood, finished goods inventory that realistically is building up at the sawmill level. And, the $1 million question is, what percent of that wood building is actually sold versus unsold at this point?
So go back to that a second. You're saying that the sawmills are only getting 30 to 60% of the rail cars that they would like to get?
I think with BC, interior, southern, because of the ongoing issues, logistical issues with the CN and CP, I've heard numbers that range from 30 to 60% depending on the sawmill. So depending on the actual producer, where their sawmill is located, though, and the big thing is getting the empties back where they belong, where there's just still significant logistical issues with the railroads. Just because you magically open a line, there's that backlog associated with it, and lumber
Correct.
is not at the top of the list. When you start to move these trains through, lumber is one of those, it's a perishable commodity, but it's not grains, it's not meats, it's not energies, it's not vital, where there's a lot of stuff that gets pushed to the front of the queue.
Sure. Absolutely. All right. Well, let's kick this off. It's December 14th. We got about 2 weeks left in the year. What a year it's been.
Yeah.
Uh, Greg, what do you want to show us first?
So let's jump to, here's just an updated January. This is as of today. So long story short, since we made the low back in November expiration, the market is officially up now about $520 or 84% off of the November expiration lows. So November expiration was literally 1 month ago. So in 30 days, the market's moved 84% higher, which, again, mimics the springtime move. Lumber never ceases to amaze us, Mike. That's for sure.
How about it, right? $500 in 1 month.
Yeah, yeah. And when you, I threw, so we just like to look at lumber, but how does lumber compare to other physical commodities, just other assets in general? And when you look at lumber, here's a 1 month return. This is from bar chart. So on a 1 month return, you're up 75.86%. You look at the S&P. S&P is the next highest performing asset at just under 11%, and then you stair step down. So this is pretty amazing that lumber in the last month by a country mile. There's nothing that comes close to the returns we've had in the last month. And then when you jump to this is year to date, we're behind oats, but we've had, just think of the volatility that we've had up and down in lumber, but just on a year to date basis, lumber is still up 90%, 90% since the beginning of the year. Even with the two-sided volatility, this market's back up 90% year to date, which is just amazing. So again, I like to compare it to other risk assets, crude oil. You can see Bitcoin here. And then you've got the lowly S&P returning just under 25%. So this puts it into perspective. What a crazy market we all trade in, being in lumber.
How about it? How about it? All right. So what's the indicators that we watch every week? What are we looking at next here?
So we'll jump to basis, Mike. This is basis as of a week ago. January, again, cash was trading at $171 discount to January.
Yep.
If I jump, and again, on a 5-year average, January should be trading somewhere around $15 under physical cash. If you go back to a year ago, this is the structure that was in place. So when you jump forward to today, January was trading around $215 over cash. And the cash that we used here was $900. Fraser came on this morning at 890, 900. They actually did sell cars to select distribution, select end users in this 890 to 900 area. But again, you can make the case that this $215 basis, again, I've heard numbers as high as 1050. So where is cash? I think you could ask 10 guys and get 10 different answers right now. But historically speaking, you still have a massive disconnect versus basis today versus historical basis. So, the one thing I want to point out here is that 2 weeks from now, today's the 14th, as you start to get into the end of this month, you will get significant convergence in the basis between cash and futures. And again, does cash have a parabolic move up to futures? If futures continues at this breakneck pace, then the answer is probably cash is going to go up severely higher, or at some point futures will at least slow down and fall back to cash. But I can tell you, two weeks from now, you're not going to be at $215, but you're not going to be at a $215 basis.
No, and 2 weeks from now, Wes Fraser is not going to sell random cars.
Yeah, exactly. Exactly.
All right. So what are we looking at? This is the March contract?
Yeah, this is March, next month out. So March is up $443 or 69%. So, again, still a sizable move higher, not at the pace of January, which is to be expected. January is your prompt wood at this point. And when you look at the March basis, a week ago, cash was 140 under March. Historical average, March should be 20 under cash. When you jump forward to today, we're about 170 under, again, using a physical cash price of $900 and Western SPF 2x4s. But that's going to be highly contested. What is actual cash? And you're not going to get a definitive answer there.
All right. So,
and then we go again, March. We're in this 45 type area. Last week we got out to around 75 to 80, kind of settled back in. And My expectation, Mike, with the current structure that we have, as we get into the back end of this month, you're going to be incentivized. The shorts in this market, I think, have a vested interest. Either they're going to EFP or potentially deliver the wood. You know, maybe they'll roll, but they're not going to be under pressure to roll. It's going to be the long side that's going to have to decide, do they want to be in that spot month where there's no limit? So I think, and you'll see this with the CFTC numbers. I did a year over year comparison or show that, where there's a lot of extra longs in this market relative to the shorts that exist year over year. So I think even though, you know, you're along this market, I don't think necessarily this spread, a year ago, this spread, this Jan-March spread went from 60 over to 130 to 200 over. It settled at 130 over. I think the structure this year, with futures being at this massive premium to cash, is going to make it very difficult for this spread to go much beyond this 80 to 100 over. Maybe I'm wrong, but I think structure-wise, that's the big difference this year. So this will be interesting to see how this plays out as we get into the end of the this month, as we get into spot month here.
I looked at the commitment of traders report, and I'm sure we're going to bring that up here. And I'm thinking the same thing. It just, who's long and who's short doesn't make sense for the spread to blow out to the upside.
Yeah, no, I think, again, the long's best friend right now is the continuous momentum higher, where futures needs cash to support it. The second the momentum starts to stall, then again, this close to expiration, it's going to be hard to justify this massive premium in January relative to cash. So again, speculation is we go higher, we go lower. It's just looking for that convergence, and I think ultimately you're going to see that convergence, and we'll see how it plays out. But I would be a little leery if I'm front spread here, Jan, March. Just understand that your front spread at this massive premium, January, over physical cash, where a lot of things have to continue to play out to the upside here to support that cause. So here's a continuation chart. You can see we pushed through the 50% retracement earlier this week. And now the next big upside objective would be a 62% retracement. And this is just taking the lows from earlier August, September, November here versus the highs that we saw, that 1733 back in May. So
what's the price at 62% retracement? What is that price?
62% would be about a 1220, 1223.
Okay, and then what's the low on that first pullback from the all-time highs?
Right here?
Correct.
You're at about $1,200.
Okay, so a technical analyst could sit there and say there's potentially overhead resistance around the 1200.
And I think a lot of the technicians out there keep talking about 1200 as the next logical upside for this market. So we'll see. First of all, Jan got up to 1136.90 today. How easy is it going to be for this market to test 1200? Do you get long profit taking just ahead or at 1200? Does that engage new selling? Time will tell. But when you're trying to extrapolate numbers on the charts here, 1200 is the next big obvious area here.
It is indeed. Okay.
And then we'll look at open interest in the CFTC numbers, Mike. A week ago, we were 2117. January was 1323. March is 684. Fast forward to this week, we're gradually still adding, but you're starting to see the bigger build in March, where, in my mind anyway, January is now a liquidating contract. You're no longer going to build organic open interest in Jan. You're going to see the build in the back months. January is going to be a liquidating contract from here on out. It might not do it in chunks, but it's going to be tough to see January build new open interest just because you're into that time frame now where people are starting to think ahead. Am I going to make or take this? Am I going to roll this into March? And you're going to start to see, I think, really the commodity funds that have been trading over the last week. I think the reality is they're probably starting to think more about March now because you're
That
this
would make,
close
yeah,
to the spot month.
that for sure would make sense. And it's a discount. Why would you,
Yeah,
if you're going to get
yeah,
long, why would you not look for the discount?
yeah,
And then,
absolutely.
you look to May. May's even a bigger discount.
Yeah, yeah, I think that definitely makes sense. And you're starting to build in the back months too. So you've guys again, hey, at least if I'm going to buy something off in the future, I'm going to buy at a discount. And then I'm sure you're also seeing sawmills. Hey, look, we're 800 plus, we're 900 plus, we're close to $1,000. If we can build out order file, even on 1%, 2% of our annualized production, why not capture $1,000 or $900? So you're starting to see interest from a mill's perspective to look at these back months as well. And then
Perfect.
if we jump to the CFTC numbers, this was a week ago. We had talked about how the managed money had stopped buying. You had this big influx of the non-reportable, the small momentum traders. They were carrying the torch here higher. You had producers kind of net selling. Amazingly enough, as you jump to the next report, the managed money component here returned. So
Yeah.
the long funds were up 170. Um, you had the non-reportables probably start to profit take here. You never, you kind of flipped back to this managed money component, and then you're also seeing, from a producer's standpoint, yeah, you added net shorts, but you also added net longs. So this is probably indicative of I can't buy the physical cash. I need to own something with an market appreciating, exploding higher. So this is kind of a good thing in that most of these areas were builds, and this is the big one where if you're going to support the market, if you can induce these guys into buying, then that's where if you can build this up to 1,000 contracts, you certainly can go a lot higher if the large funds are in participating. That becomes much more supportive for that momentum move higher.
Yeah. This, I think, is probably the most telltale of all the statistics to look at this week. And it basically is as expected. We're at a price point that you don't get here without, buying in. You need to put some logic as to why futures would be running such a premium. It runs a premium when managed money, when speculators are getting in because they like the liquidity of being able to exit a futures position, of course, and they're willing to buy futures at a premium to the cash market. The
Yeah, and I think the big thing there is just the liquidity of and you look at the last week, daily trading volume has been a little anemic. It's been a little disappointing, but there's still liquidity where talking to guys in the cash market, I'm going to ration my wood because if I sell something, I can't replace it. Where you're seeing truck type guys sell a truck, sell two trucks. Okay, we're going to cap it at X amount of trucks per day, and then we're just going to go off the market and reset. Where I think I might not necessarily agree with the premium in January, but at least in March, May, I'm going to buy the equivalent of physical cash, or where I think perceive cash to be, or a discount, and at least good, bad, and different. At least I have the liquidity. There's a little bit more liquidity in the futures than in physical cash when the markets ultimately stall out.
and this is going to be an interesting expiration. They always are, but if the cash product is not available that the market wants, they're going to hold these futures and they're going to look to some sort of EFP.
Yeah,
Um,
yeah, yeah.
so
No, absolutely.
I think for the convergence to happen somewhat orderly, we need to come back from Christmas and have some wood available. Um, so we need to reward the shorts right now and let that basis come together. We need to let the futures market and the cash market move closer together. And
Yeah, yeah.
ironically, that might free up some wood that's sitting in reloads in a basis trade. Like it's hard to exit a basis trade that you put on at $80 premium at negative 200, right?
Yeah, your time is your friend, and you're going to wait it out. And it's one of those things where conceivably, if it doesn't make sense, then inevitably you might roll that January into March and just continue to sit on the wood and wait for the convergence in the basis.
Right. And I think we might be seeing some of that kind of already, where you see the March spread has accelerated to the upside. I'm sorry, the March to May spread has
Yeah,
accelerated to
yeah.
the upside, and the Jan to March spread has pulled back modestly.
Yeah, I think the Jan March has been a little bit more muted. The March, July, they've definitely widened out. Part of that is just the illiquidity of you're always going to be more illiquid in that second month of the spread, where March is going to have more love than May is going to have more love than July. So it becomes very easy to notionally push these spreads out without even trading, where nobody's fixated. If I'm trapped in March, then I'm going to think about offsetting in May, or if I'm trapped in Jan, I'm going to think about offsetting in March. Once you get out beyond May, once you get out beyond July, you're not really using those contracts as an offset as much as you really. When you look at July and September and even the November contract, you really have a purpose or a reason to be in those months, whether long or short. You really people that are in those months this far out are well thought out, where there's a rationale, there's a reason behind being in those months. When you get into the first 2 months and even into that third month, you're going to get sympathy buying, selling, and limit up, limit down type moves where, hey, I can't buy Jan,
Sure.
it's locked limit, I better go by March, I better go by May. uh, just to offset some of this exposure to the upside. If we're going to be locked limit up again tomorrow, then maybe instead of losing $45 outright, I'm only going to lose 20 because March is going to move up half of Jan type strategy.
All right, let's roll into options here. I know
And
we
then
got a
I
great
know
topic.
we're rambling on here. I just want to show one more
Sure.
chart, and thanks to Alex at Stone for putting this together. But this just shows year over year. So this is a CFTC Commitment of Traders report that shows this year versus last year. And the two numbers that jump out here, Mike, okay, managed longs basically mimic where we were a year ago. So a year ago, open
Okay.
interest was 29.36. Today we're 21.56. Oops, sorry. Let me go back here. So we have almost 750 less contracts year over year, but managed longs are in a very similar position. The big number that's night and day versus a year ago, look at net commercials. So these are commercial longs versus commercial shorts. A year ago, we were 1,200 shorts. We're sub 600 today. So there's significantly less commercial interest, and that's twofold. Okay, we're not at this obvious discount in futures where it's just, hey, I'm just going to buy something. Futures is cheap. It's on par with cash. I'm just going to go buy futures. And more importantly, even with this massive premium, the move to 1,500, the move to 1,700 has been a big red flag for sawmills. And let's not get in over our skis, too far out over our skis. You're basically, when you kind of look at commercial shorts versus a year ago, you're significantly less than where you were a year ago.
Yeah,
So it's
and
not as
there's
obvious, even at this premium structure, at this basis structure, sawmills are still apprehensive. They're nowhere near where they were a year ago as far as being short.
and from a structural standpoint in the market, meaning the same players are in there. They're basically producing the same amount of wood, and they've chose to hedge 50% less or
Yeah,
100%.
50% less. And when you go back to that basis, a year ago, you're talking a $300 to $400 swing in some of these back months where the structure, you're being rewarded by $300 plus in March and May right now, year over year, and there's still apprehension to use futures as a risk management tool. Where the what if scenario? What if we go to 1,200? What if we go to 1,500? What if we make new highs? We want to save our ammunition. Just in the event that happens, we don't want to be too far in where we can't take advantage of it.
Absolutely. All right, it's going to be interesting to watch these numbers moving forward here for sure.
So we're going to jump, and I know when we left off, we were kind of talking about call options, and again, to kind of reiterate, buyers of a call have the right but not the obligation. The seller of a call has the obligation to sell futures. And I think that was the last slide. So in this example here, we talk about an in the money call, at the money call, out of the money call. And so intrinsic value is always going to be the underlying value of the asset. So lumber here, you've got a call price of 550, futures price is 570. So this is an in the money call, meaning the call at 550 is below where the futures contract is trading. So this is considered in the money. At the money, the call strike price equates to where the futures market is. Out of the money, call is above where the futures market is. And we'll get into, I think this, we'll get into specific examples to help clarify this. So lumber put options is just the opposite here. So if I'm long a 590 put and futures price is 550, I'm in the money by $40 a thousand. If futures is 550 and I have a 550 put, then they're at the money. If I'm out of the money, if I'm long a 540 put and futures is $10 above, then I'm out of the money by $10.
Now, one of the things to note, though, is you can be out of the money and there's still value in that option because there's time value.
Sure. And we'll, funny you should mention that. We'll actually, so just like the call option, a buyer of a put has the right but not the obligation. The seller of the put has an obligation, especially if it's in the money. And again, we'll get into some examples here that spell this out. But I want to. It's funny you brought up the time value. So what constitutes? How do you price options? How are options valued? And these are the time value components. This is what goes into an option. How do you value an option given all these different variables involved? And I think the biggest thing, and just so everybody knows, Mike is an expert in trading options. Mike for years was a option market maker in lumber options amongst other markets. So you've got a wealth of knowledge as far as pricing options from Mike. So Mike, anything you have to add, then by all means jump in here.
This is actually what you put up is perfect. Those are the components that go into how that option is priced. Fortunately, in today's world, we have technology, so you pump them into a computer program and it spits out, a value for you. But I think it's important to know time is, one of the most important aspects, and the option pricing is so sensitive to time. Well, it becomes very sensitive to time. Once the option expires, the game's over. So factoring in how long you have to play the game is an important component. But then, the volatility. You can have all the time in the world, and if you have no volatility, there's not much value in that option.
Yeah, absolutely. So, you have a market like lumber where you've got January options that go off the end of this month. So your time decay is getting pretty steep. And what I mean by time decay, and we can jump back, but basically, if this is your time value, this is days to expiration. So, if I'm going to put January options on this chart here, this is January, somewhere around here. You've got until the end of this month. So with each passing day, the time value associated with January options is starting to decay. And that decay, especially for out of the money options, starts to happen more rapidly as you get to expiration day. Obviously, if you're in the money, then an in the money option is going to function as a futures contract within reason, regardless of the time. As you get at the money or out of the money, then you can go from having value in something to having no value in a matter of minutes or hours, depending on where that strike price is relative to the intrinsic value or the underlying price in futures. So these are all critical things to understand. And the one thing, if I'm buying an option, this time value is critical, especially as I get closer to expiration. If I'm selling an option, then with each passing day, as long as I'm not in the money or at the money, time is working in my favor. With each passing day, and being the writer of an option call or put, if the market's not moving in my direction, if it's moving in the opposite direction, then that time decay works in my favor, where that asset has a natural loss in value because of this expiration to zero. The time decay works in my favor.
Yeah, let's just look at what time decay actually means in the current market. So we're trading at 1120. I show fair value right now on an 1120 call or put is right around between $60 and $65.
Yeah.
So let's remember that. It's like, right, we'll call it $60. And next week we'll take a look at what the at the money call options are worth.
Yeah, and we'll reference. I'll make a note of that, add it to a slide, and we'll reference this next week.
All right, perfect. And for the record, the volatility I have priced at around 62%.
Yeah.
And I think what we need to define volatility. Oh, we're at the 32-minute mark. Let's just finish up with volatility and kind of let people think about it. Volatility is the wiggle. It's not necessarily just the straight line move, but it's when prices go up and back down and back up. And, it's important to understand what time frame you're looking at for volatility. If you're looking at the year over year lumber pricing or lumber pricing across the year, it's very volatile. But if you're looking at the January and the January, February, March options right now, your time frame is so compressed. How volatile are we going to be in that time frame? Let me pull up. I'm going to pull up a January chart. I wonder if I'll be able to show this. Well, we'll show this next time. It's just really important to understand that volatility means up and down, not just one direction.
Yeah, absolutely. And maybe next week, Mike, as we get into specific examples, we'll also cover some more option terminology. We can kind of show pertinent examples of volatility, of what delta means, kind of get into some of the basic terminology of options, and kind of going back to how the valuation of an option, how these things are relevant, as far as being on the buy side or being on the sell side of an option, being a speculator, being somebody that's looking at a risk management strategy. There's a lot of things that go into options trading, and hopefully through specific examples we can kind of make this clearer as we progress through
Sure.
this.
And in my opinion, it's very important to understand who's on the opposite side. Or, what type of entity would be on the opposite side of your trades. Helps you understand value a little better. So, and we're going to go over strategies. Like, there are some great option strategies we talked about a little bit before this call. If you're a mill right now, you can buy puts and sell calls and basically put on some sort of risk management at a zero cost.
Yeah, absolutely, absolutely. I think the options, in their easiest form, help define risk. Where if somebody is more risk adverse, then at least you can quantify risk in using options based upon the strategy, and as a way to enhance the underlying physical asset, whether you own physical cash, you produce physical cash, or you have an underlying futures position, there are ways to utilize options to help mitigate some of that inherent risk in the actual asset that you own or you think you're going to own. So
Right.
this is lots of examples to come, and this I think we both get excited, passionate about talking about options because they're such an integral part of what we do on a regular basis.
Well,
They
and
do
they're just
value.
they're a great strategy, even for taking some profit on a trade.
Absolutely,
If you don't want
absolutely.
to exit the trade, you can take some intermediate profit using options.
Absolutely. So, yeah, definitely. We've just scratched the surface when it comes to options. That's for sure.
Perfect. All right, let's kind of wrap this up. So, this market's on a run. Can't argue with that. We've kind of gone through overhead resistance. I think it's interesting that we've identified the mills are less hedged right now. It might explain a little bit of this run and the speed and velocity with which we went higher. Um, I would anticipate seeing some mill hedging coming in as
Yeah, and
we
Mike,
move
I think
on.
that's a great point. That the smaller hedge position that's out there was definitely much less resistance on the way up here, where instead of having the usual suspects scale and selling, adding to positions, initiating positions, when you're 50% less than where you were a year ago, that's 50% less resistance in pushing this thing higher. Less is more in that it takes less contracts. When you don't have that consistent selling on the other side, it takes a lot less from the buy side to push the market higher. That's a
Yep.
great point.
All right. Take care, everyone. We're going to see everyone on the 21st. Be safe, trade safe, and we will talk to you